credit bureaus, it only looks at a small subsection of things, like have you borrowed money, and if you have, did you pay it back? It doesn't look at how much money you make. It doesn't look at what assets you have. None of these things are considered.
Welcome back to This Week in Fintech's podcast. I'm your host, Nick Milanovich, and I am really excited for today's conversation because it is with Andrew Endicott. For those of you who may not know him, and I feel like most of our audience does, Andrew is the co-founder and general partner of Gilgamesh Ventures. He's also a board member at Encore Bank and previously was a co-founder and president of Pedal, building a credit card using cash flow underwriting. Andrew also hired me at Pedal, so he's my former boss. And now he's about to be a New York Times best-selling author. I'm really excited to sit down with Andrew. It's been way too long, and I wish this was in person, but it's good to see you either way. But I'm excited to sit down and hear a little bit more about your upcoming book, Is Finance Technology? Insights for Building an Enduring Fintech Company. Good to see you.
You too, man. This is awesome. It's cool to do this, and excited to hear what we're going to talk about.
So the treatment for the book you sent me, which I got to do a little sneak peek of, was really cool. I'm so curious to hear the thinking behind how you broke it out and a few of these chapters, which really goes into different parts of the fintech universe and the trade-offs that people should think about when they're building. I thought maybe we could start by hearing a little bit more about everything else you're doing, just so that people have context. But I do want to call out, I love that the book has the Arkansas state on the first page, and it was written in Fayetteville.
Yeah, that's right. The publisher's Epic, which they're based there. So it was really cool to have them involved. Yeah. I think it's a good place to start because the book really does reflect a lot of kind of its author, which is me, and kind of what I've done kind of in life. And Nick, you gave a lot of the things I'm up to, but I'll kind of just start from the beginning. So in terms of my career, I graduated from college right as the financial crisis was beginning, and which, in retrospect, was not the greatest time to start a career in a lot of ways, not the greatest time to get a job, and so unsurprisingly, I decided to continue my education. I went to Harvard Law School, and I'd done well on the LSAT and was able to get in there, and so I took that opportunity, did my 3 years there, met a lot of really great people. Enjoyed it. I was not the smartest person in the class, which is probably not surprising if you met me, but really enjoyed it. But came out with a lot of student loans that I needed to pay off. So I kind of sold to the highest bidder and moved to New York and started working for a large corporate law firm. And I did that for a while. So I was a lawyer to begin with, and spent several years doing that, working on large corporate deals, M&A, private equity, acquisitions, and so on. And I really enjoyed it. And I worked with a lot of different industries, but I didn't like that lawyers don't really get to make decisions. I wanted to be a decision maker. And so figured out that law was probably not for me. I wanted to be a business person. So I left there. I next went to an investment bank called Lazard. And that's where I started to really encounter fintech. So I worked mainly in kind of exits, M&A transactions for companies that were lenders. They called themselves specialty lenders at that point, but really today these companies would call themselves fintechs. So I did that for quite a while, met some really interesting people, learned how lending works, and started to see some opportunities myself. And I'd always wanted to do something entrepreneurial, and I saw a great opportunity in the credit card space, and had a really good friend from law school that wanted to start something too. And so we both left our jobs and started Pedal in the credit card space, like you mentioned, and spent a lot of the next decade building that business from soup to nuts. Our mission was to expand access to credit by using bank account data or cash flow information to underwrite risk, which is still, I think, somewhat of a novel idea, but it's a very novel idea at that point. You had technologies like Plaid and Yodlee, Finicity, and others finally, for the first time, giving third parties via open banking the ability to see transaction information in a consumer's bank account. And we had the crazy idea that we could use that to underwrite credit for people who didn't have credit histories. And that was really the foundation of the business. And settled on the credit card as really the way that we were going to manage a relationship with the customer, use that to underwrite, and built a pretty large business over the next several years. We ultimately were doing over 100 million in revenue as of the time we sold the company several years back. But along the way, I fell in love with fintech. I love entrepreneurship. I've seen this world from the lending and kind of the banking side of things than everything else. But as that chapter closed, I really wanted to stay in that world. Didn't have any driving, passion to start another company, and so very naturally, I think becoming an investor made a lot of sense. So I partnered, as I said, as Pedal ended, partnered with my friend Miguel Armaza, and started Gilgamesh Ventures, which what we do is we invest in fintech companies globally, and I kind of have the background as an entrepreneur. Miguel spent a lot of time in the banking world. He also has an interesting media side of what he does. But we invest at the seed stage in companies really building the future of finance. And about half of it's in the U.S. and half of it's outside the U.S. So we really can invest anywhere. A lot of the investments we made are also in Latin America, which is a strength of ours as well. And as you mentioned, I've been an entrepreneur. I'm an investor today. I also spend a decent amount of time in the kind of the traditional side of finance as well. So I'm a board member with Encore Bank in the southern U.S., operates in several states in the Southeast and the Sun Belt. I've done that for, I think, 8 years. And I'm also more recently a board member for Mangrove Insurance in Florida, which provides homeowners insurance to people in Florida, which is a very unique and interesting place to have insurance given hurricanes and all these things. So I think that's my background. I've been kind of on both sides of finance, the side that's innovating a lot with the technology and other models. And I also spent a decent amount of time kind of in the more traditional stuff as well.
So, starting at the beginning of that story, you're at Willkie Farr for a couple of years, and you're at Lazard for a couple of years. I'm curious, in that tenure, where did you start saying to yourself, hey, there's much more interesting opportunities happening in tech and fintech specifically? What were the light bulbs that went off? Because there's so many people who come from banking or consulting and they end up going into fintech, and they're like, yeah, it was infuriating to see how poorly things are managed at scale by enterprise financial services companies.
Yeah, there was a lot of little things, dumb stuff like chasing around a wire that had vanished. That happened to me a lot, actually, over my career, both as a lawyer and a banker. One time I lost a wire that was very large. I don't remember exactly what it was, but I think it was approaching 9 figures, and it just was kind of unaccounted for, which is crazy. We eventually found it, thankfully, but little stuff like that happened all the time. But I think also as I was particularly at Lazard, in a little bit at Willkie, I worked on the Yodlee IPO, so that was part of it. I got to see open banking and fintech really in its infancy. You'd had PayPal a number of years earlier, but there hadn't been a whole lot after that, and that was the beginning of a wave that I think really started post financial crisis, and was really significant probably until a couple of years ago. But I think really at Lazard, the companies we were working with were filling a gap that had really been created by the financial crisis, where you had the financial crisis, banks were in extremely bad shape after that, and in Congress and the government stepped in and passed a bunch of laws, mainly in the form of Dodd-Frank, which most people really don't think about today, but it really drove a wedge between what banks can do and what they can't. Mm-hmm. And it really constrained what banks can do. Banks used to be able to do a lot more stuff than they really do today, and that's changing some, but it's still mostly true. And as a result, there emerged this kind of ecosystem of different parties, different actors filling the gap, because a lot of consumer needs and business needs were just not being met by banks, which were hamstrung. And so these institutions started by calling themselves specialty lenders. They used technology a lot more than banks did, mainly because they were just new institutions, but they also had to be resourceful. They had less capital to work with, and they had to do things differently. And that was really probably the beginning of where I started seeing this. I worked with some alternative lenders while I was at Lazard as a banker, and it was a pretty natural evolution. I think the smartphone, really had come into its prime with Uber becoming a mature company. It was just very obvious that there was going to be a lot of change in finance, because there had been change in a lot of other parts of the consumer world, but not as obvious in the finance world when I was getting started. Whereas today, that's not really true. We've got a lot of very established fintech companies, but at the same time, I would argue we're kind of starting over a little bit with generative AI in that innovation cycle, which probably will occur a little bit faster, but definitely will take some time to unfold. So I think it was a couple things. It was direct experiences, basically, dealing with a very, very rigid financial system, having problems with it in a practical sense, and then just the amount of change happening in the economy drove a lot of it too.
Yeah, it's interesting. You're talking about early fintech, and Yoli was part of that cohort. Another part of that cohort was Lending Club, and I know Renaud, who is the Lending Club founder, writes the foreword to your book. So we'll get into that in a little bit. But Renaud actually and Lending Club are a great analog to what you and Jason started at Petal. For people who aren't familiar, Petal, which was recently acquired by Empower, was using cash flow underwriting back in 2016 to be able to price people for credit. And so the idea that you were locked into the score from the three big CRAs in order to be able to assess whether or not you deserve credit was already really outdated. And it feels like a niche market. But then you think about anybody who's moved to the US without a credit history, anybody who's younger, anybody who has uneven cash flows, anybody in the gig economy who has cash flows but doesn't have a W-2 salary or a job. It's just an increasingly growing segment of the population. And I feel like you guys saw that back in 2016 and realized, hey, there's an actual opportunity here. Now, right. Every fintech company is talking about AI and generative AI, but you're using machine learning back then to be able to underwrite people using, nothing but ML models in order right. to be able to assess cash flows. I'm curious, what made you decide, I've got student loans that have paid off. I've had this comfortable banking job. I've lost a wire here and there, but these guys like me pretty much. What made you decide I want to take the leap and be a founder?
Yeah, I don't think it helps that the corporate culture on Wall Street was, let's just say, a little demanding. That was definitely part of it. I don't know if it's gotten better or worse in the last several years, but it was pretty intense when I was there. But a lot of it, I think, goes back to people. Jason and I, when we started Petal, we had a really good friend named Burke Uston, who was also a co-founder of Petal. Burke had been an immigrant himself from Switzerland. And we'd met him when we were both in Cambridge. He was at MIT and we were at Harvard Law School, and became friends and got to know each other. And Burke had over the years that we'd known him, he had all these weird problems with the financial system that, some kind of computer scientist, quantitative guy from Switzerland you think would not have a lot of problems with the financial system. That sounds like somebody who has a lot of solutions for the financial system, or who this financial system really wants. And that was weird. It's just one of those examples that struck with you. This doesn't really make a lot of sense. And at the same time, all this data was becoming available, which I think is something that's a little hard to see today compared to what it was then. That if you go back to the 90s, the credit bureaus were amazing innovation. These groups that they found ways to collect all this information that they had themselves. Nobody else got to touch it. It was theirs. They built that into huge businesses. It's not just one of them. You've got the three big ones, and you've got some other smaller ones. And really the entirety of consumer finance, at least, was built on that edifice. That information, that data at credit bureaus. But the problem is that information is very incomplete. It only looks at a small subsection of things. Have you borrowed money? And if you have, did you pay it back? And how much money have you borrowed? And boiling it down, that's really what credit bureaus look at. It doesn't look at how much money you make. It doesn't look at what assets you have, which is particularly wild. That it doesn't look at how much cash you've got, whether you have a car that's paid off. None of these things are considered, and so that there are huge deficiencies in it. That if you were to apply those same things to Burke, for instance, who had a good job and was making a great income, he should have been able to qualify for most forms of credit. But because he didn't have this specific credit bureau type of data, he couldn't. And so as all these things were kind of happening, Jason and I were sitting around and looking at this and just said, there has to be a huge opportunity here to change how people underwrite credit. And there was. We were able to build that into a very large credit card business. And today, it's thriving with Prism in the cash flow underwriting space on its own, which Jason still is running. And so it was a combination of people, what's happening in the economy, and then just things that we saw, and probably helped a little bit by not wanting to work 100 hours a week at a place where you didn't always feel appreciated. That's probably what.
I'm sure they appreciated you. It does seem like, Wall Street, I don't know, people think of Wall Street as a fixed thing, but it does go through waves and changes. And there was the pre-Dodd-Frank era and the post-Dodd-Frank era. And now, to your point, things seem to be changing again. And you have a lot of the role that banks used to play being fulfilled by private credit, being fulfilled by non-bank lenders and institutions. And I guess you could say that fintech is also stepping in and playing a lot of the role that we would see banking play beforehand. So I'm curious to learn a little bit more about the book. So the book, for everybody, what's the date that is coming out?
April 1st.
April 1st, April Fool's Day, is Finance Technology, Insights for Building an Enduring Fintech Company by Epic Books and Andrew Endicott. What made you decide to sit down and write a book? I mean, I've never written a book. It seems like a huge enterprise to undertake.
Yeah. So I didn't, I never really had thought a lot about writing a book. It's not something I dreamed of by any stretch of the imagination. I really just found myself over the last several years having a lot of ideas that I didn't really hear anybody else saying. And I don't want to say I'm like this tower of originality or anything, but I'd seen a lot of things from my perspective that I hadn't heard other people voice about entrepreneurship, about finance, about fintech, about business, about markets. That I honestly, before I got hit in the head hard at some point or hit by a bus, I just wanted to get on paper before I forgot them. And that was really a lot of the reason why I wanted to write it. Is I had ideas that really just voicing them in conversation didn't feel like enough. And I don't have a huge social media following that really would want to read them. So a book was the best format for me. And I wanted to be kind of what I've seen. I wanted to be from kind of my viewpoint, not really a survey of what other people have seen, but what I've seen. And so the structure of the book really, it goes back, it looks at, kind of says who I am. It goes back and it looks at how finance has worked over the millennia, which is a weird place to start a technology book. But I did it because part of my thesis for the differences between fintech and finance and what makes fintech companies successful and so on and so forth is that at the end of the day, a lot of this stuff is all the same. There's just categories that are created by different market features and regulation and so on. But the problems that fintech companies and banks, insurance companies, and other finance businesses are solving are really often the same things that they've always been. And people are just using technology to solve problems in a better way. So I begin with going through history of kind of how finance has changed over time with the invention of writing, the invention of computers, smartphones, getting us to today with generative AI. And then really the way I take the book from there is, how you start a company, how companies in fintech really get going, and how they evolve over time. And part of this it's part of a course that I've taught over the last couple of years at where I went to college. And so I've gone over this material quite a bit, just kind of speaking it out loud. And then last, I really talk about the different components of the different types of fintech companies. So ranging from banking to payments to insurance to infrastructure, those four big categories, banking, including both credit and deposits, and how those different types of businesses are built. So that's kind of how I organized the book. But throughout, it's really just the as partially through being an entrepreneur, partially through being an investor, and then other experiences I've had, kind of what I've seen that works, what I've seen that doesn't, and most importantly, the things that are often just missed. To me, there are a lot of recurring errors that entrepreneurs in fintech make that pertain specifically to how finance works as opposed to how entrepreneurship works. And I wanted to voice those, and they typically come down to things around risk, compliance, fraud, these kind of unique things that finance and fintech have that other spaces just don't. So I wanted to talk about those things, and my goal for the book, hopefully people will read it and find some, find an opportunity to avoid making a huge mistake that's going to derail their company, or a board member can make suggestions to an entrepreneur that help create better outcomes. But that was generally the motivation for me. And the title also is finance technology, gets back to a lot of the central theme is that if you zoom out, what we're doing today is just using technology to solve the same problems in a different way. But the problems at their core are often really the same.
Yeah, I like the taxonomy that you use. So the book's divided into 3 sections. One is, and so it begins, and it talks about the founders and the personalities behind fintech companies, how to raise funding, whether you just start a fintech company at all and go through this. People say you're signing up for a 10-year journey, but I don't think anybody really internalizes how long that 10-year journey really is until you actually are like halfway down it. The second section is the 4 horsemen of fintech. And I really like this taxonomy because it goes into banking, payments, insurance, and infrastructure, which also speaks to your own experience. Banking, you're seated on core bank, payments, obviously what you built at Pedal, insurance with Mangrove, then infra, which is what Prism's become now. And I feel like that's a pretty common trend in fintech, is you see a lot of companies start with a direct to consumer offering. And the idea is, well, yeah, of course this is good for people. And then you realize that a lot of the problem is actually down the stack. And a lot of companies become enablers rather than direct to consumer companies, because you want to solve this at scale, but meet consumers where they are. I think Paddle, by the way, had 400,000 cardholders.
400,000, 500, something in that area. Yeah, they get close to
cardholders at peak.
Yeah,
so
that's right.
Cash flow underwriting is definitely not a niche problem to solve. How did you kind of put together a framework to break apart these 4 categories? And how do you think about them in distinct ways?
Yeah. A lot of generally the book, I didn't sit down and research how to write this book. It was kind of a series of things that I have spent time thinking about at various times throughout the years. But this part in particular, I think it was probably 2 years ago. For Gilgamesh, we were writing something to our investors. I don't remember what it was. And, I think this was probably 2023, probably. And you probably had the same kind of general observation that 2023 was a really interesting year because it felt like we kind of come full cycle on a lot of things. Looking back to, you had at whatever point post-financial crisis, the smartphone really came out or started really getting adopted. And then there's this huge wave of innovation. And then by 2023, a lot of the, kind of the land had been claimed in fintech. There a lot of the ideas had been tried. And then but also in 2023, you started to see the glimpses of how this is going to happen again with generative AI, which is just a platform innovation on the level of the smartphone, probably bigger, depending on what you think is going to happen and who you're talking to. And as I was looking back in 2023, I wanted to kind of draw a little bit, kind of just look at the scoreboard for what had succeeded, what hadn't. And I think to do that, you kind of got to carve things into categories. You've got a ton of subcategories. You got neobanks, you've got crypto, you've got lending companies, you've got anti-fraud, you've got compliance, you've got all this stuff. But to me, there were really 4 big buckets: banking, insurance, payments, and infrastructure. And I think there were some just general observations that I had. I think, if you really look at the data pretty objectively, I think payments has had a lot of success. I think you had companies like Stripe, like Adyen, like Bill.com, like others. There's a lot of these businesses that have really gotten big and have really thrived. And I think there are features of payments that make it to where some of those businesses are not necessarily easier to start, but if you get the right place in the right time, you can create something huge, and you can create a first mover advantage and network effects that are really hard to catch. So that was an observation. On the other end, there's observation that although there've been some successes in insurance, it really they've been different. You've had some companies IPO, but it hasn't gotten nearly the attention that other categories have gotten. And even those IPOs have not performed always the best. So I spent a lot of time thinking about why that is, and I still haven't really figured out the exact answer, but it's definitely an observation. In the banking side, you had a ton of activity. And I think the results are more, there's kind of more of, it's I don't know if I'd say mixed, but there's a lot of variance in the results in banking. You've had a lot of really big successes, Chime, SoFi, Affirm, others that have gone and done really well, but there's a huge amount of capital that went to that area that some of it went well, some of it didn't. And last, to your point, infrastructure is, quietly also some of the most successful companies. I think you've got companies like Prism that kind of came out of, a direct to consumer or another business to create things that banks and other lenders and other fintechs can use to be better at what they do. And then you just had a lot of pure software that really is just a step change function better than what you had beforehand when just in terms of the quality of the technology. And so I that's how I kind of cut it. It was really to understand what had succeeded, what hadn't. There are clearly like big winners and big losers in all those categories. But to me, that's the clearest way to kind of carve it up in a way that makes sense.
So if you were advising somebody starting a fintech company today and they didn't yet have an idea that they really gravitated towards, I'm curious, which of these sectors do you feel like you would push them towards today?
Well, as a threshold matter, if they didn't have an idea they were really passionate towards, I might tell them they shouldn't be an entrepreneur. Because there's a, when times are tough, having a little religious fervor behind you is helpful. But kind of that to the side. I think it's an interesting question. I don't know. I think like I said earlier, the innovation kind of life cycle is restarted. It restarted 2023 or so. Whenever Chat GPT 2 came out is probably the dividing line for when that began. Depending on there's a lot of different ways you can cut it. And I think that we'll probably see different outcomes this time. I think that we're going to see similar levels of activity, and we already are. Across all of these things, all of the infrastructure is going to be, for the foreseeable future is going to be primarily generative AI driven, but also some crypto and blockchain driven things. There's continuity with that. And then I think, I don't know, Nick, if you've read kind of the Mickey Malik, his article a couple years ago about the death of fintech, which is a little bit related to all this as well. That all the big treasure chests had already been seized. You had the winners are established. You're not going to be able to unseat them. And I think what's happening now is, in reality, there's a new race to go after the same pot of gold in each of these markets, and that race the rules of the race has been redefined by generative AI, and you're going to see the exact same thing happening today that you saw 10, 15 years ago with the emergence of the smartphone. And so I think there's some very exciting things you can possibly do around banking and credit and lending and deposits. We're going to see a lot of in essence, kind of neobanks, if you will, that are using generative AI as the platform layer for those businesses, and engaging with their customers using a different form factor. I think the same thing is going to happen in the insurance space. Maybe there'll be more success this time in insurance, and then payments will probably be the same thing. Although I think the interesting thing for me is payments. It's not clear that the depending on which there are definitely some parts of payments where there's going to be heavy impacts from generative AI, but I think it's not. There are going to be some parts that aren't, and so there's a lot of people building interesting business around agentic commerce, which I would generally call kind of a payments kind of activity, although it's not entirely. That's probably going to see a lot of change. I don't know if the kind of the individual payment rails are going to change that much, although stable coins are a huge area, which is totally unrelated to Gen AI for the most part. So more of that activity is it maybe not going to be the AI, but it's going to be other stuff driving a lot of it. So I don't know is the long answer. I think I don't think people should really. I'm not a big believer in looking at TAM and looking at market size and these abstract ideas for building a business. I think you really, I believe that people should start the businesses that they're passionate about. People should start the businesses they're going to be good at building. And so if you have a lot of relationships in one space, or you have a lot of knowledge about one space, or you have a network in it, or just a zeal for changing it, if you've encountered a really significant problem in your life that you want to solve, that's where you should go. It shouldn't come down to creating an Excel spreadsheet and saying this is where the technology is most applicable. That should be part of it, but that's not the driving force. And I think there's going to be huge defining, kind of market defining companies in all aspects of these categories. But we'll have to see who they are.
Yeah, I like that you brought up Mickey's. So Mickey, for people who don't know him, is one of the co-founders of Rivet Capital, which is one of the most successful fintech investors the past decade. One of the most successful VCs, period, over the last decade. But the piece on the death of fintech is interesting because you kind of have these generational waves where a couple companies set the tone for new ideas. In fintech, probably like Robinhood, like best categorized that like post PayPal wave of, hey, we're going to go into other products and just make them work better for people by bringing them online, cutting the costs, and just making it like a really easy web interface. But you probably can't start Robinhood today. Like there's not that much room in the market. You can compete on brand and maybe you can compete on some kind of pricing, but there's not that much room in the market for like multiple Robinhoods, because that's what internet businesses do. Is it becomes a little bit more winner take all. You don't have to go into your local Robinhood branch and like, I'm not walking into my Fayetteville branch of Robinhood and then my New York branch of like the New York Robinhood. But when you have platform shifts, that really does open up new opportunity. And so, probably the most important one is the one that you brought up, AI. If generative AI becomes the new platform that people are using to access information and access services, then all of a sudden, all these business models look a little bit shakier. And, Robinhood's great. But if I have an AI native version of Robinhood that sits inside whatever service I'm interacting with, whether it's ChatGPT or Claude or whatever else, and I could just say like, hey, set up this trade and, make it a limit order and bail me out if this happens. Like that's a lot better than me having to go log into a platform and like click through the interface and understand things. And I can just ask things like, what's the latest pricing? What's the 10-day forecast? Like what, does the history look like? So, maybe this isn't the best example, but when you have like mobile or internet or AI or other big platform shifts in how people access information, you get a lot of new opportunities to build new business models. And I feel like we're kind of right on the cusp of one where, what got you here isn't necessarily going to get you there. And what makes you a good fintech founder is going to change. I'm curious how you think about it.
Yeah, I'm not going to claim to know all the answers. I mean, there's a lot of smart people talking about kind of what makes an entrepreneur in the era of generative AI, succeed versus before. A lot of people are talking about how knowledge is less important. A lot of people are talking about how, kind of team building is different. And I agree with both those things to some extent. And I do think deeply understanding context is still really critical. I think and again, going back to the whole theme that I wrote about, I think the understanding why financial markets operate the way they do generally requires some time spent in it. There's a lot of counterintuitive things that happen in most parts of the financial system that you really don't understand until you've dealt with it as a business person and seen it go wrong. I think fraud often is the biggest one, but there's other stuff too. I think compliance is a big one. And I think that is not something that generative AI is going to change. It may actually magnify. I think there's a chance. Really deeply understanding those things. And I think also some of the problems in the financial system are going to get worse. I think the one that I don't just think about in my day job, but I think about daily in my personal life is, the evolution of fraud itself. Is I can feel it getting worse, and everybody else can probably feel it getting worse as well as fraudsters use these new tools as well. And that's gonna create a lot of disasters, but it's also going to create a lot of opportunities for people that know how to solve those problems for financial institutions and for other fintechs and other financial actors. So I think understanding context is still very important. I think understanding how to build something that doesn't create huge risk of downside is still really important. It's something that uniquely characterizes companies in the financial space, whether they're fintechs or not, that mistakes can blow up your company. And it happens in almost every part of the financial stack, including software. There's some things you simply cannot get wrong, and if you get them wrong, you forever lose trust of a lot of either your customers or your partners. And so I think people that have the right, I'd almost say like the right temperament to not just see the good things, to understand how things can go wrong with the right level of risk tolerance. If you're an entrepreneur, you can't just go around like a pessimist seeing bad things all day. You'll never do anything. You have to be an optimist, but you can't be a blind optimist. You have to be a kind of a realistic optimist who takes problems really seriously, particularly the big problems really seriously. And the point where that becomes an issue is not really when you're starting out your business. It's really as you start to get scale and getting from some scale to a lot of scale. A lot of what separates those companies is really the temperament of the people running them, I think. So I think
totally agree with that. Like, I think the way I put it well is like hardiness. You're hardy. You can deal with problems as they come up. You expect more problems to come up, but every single time a problem comes up, you know that, all right, well, we will solve this. It might be a 1 week thing. It might be a 3-month thing, but we will figure it out.
And the last thing I think is, and this is something I'm sure you've seen as well, Nick, the just speed. I think speed was important. Speed is probably more important now. And I think speed is misunderstood by people that don't work with entrepreneurs. I think speed is similar to recklessness. I think that's how a lot of just and people in the general population see it, but it's really different. Speed most of the time comes down to understanding how much information you need to make a decision and understanding the relative reversibility, upsides, downsides of a given decision, and according the right amount of time and focus to the right decisions. And so some people call this, I think a broad term is decision velocity. Can you make a lot of decisions? How quickly can you make a lot of important decisions? And making important decisions is it's not like, I wouldn't say that it's intellectually hard. It's almost emotionally or psychologically hard because you're easy. It's easy to get overwhelmed. It's like a feature of personality or maybe experiences. I'm not sure. And I think sometimes there are like elements of cultural forces at work with this too. If you interact with many Israelis, they're really good at making decisions really fast. But I think that your ability to make decisions, high stakes decisions quickly and well, although I'd almost say quickly is as important as well, the importance of that has increased. And it's probably never going back. I think you're gonna, that's the world we live in, that the people that can do that effectively are more important today than they've ever been. And that is a really, really important skill for building a successful company.
Yeah, you see people talk about ramp a lot in this context. Keith, who's now at Coastline, but was at Founders Fund when he backed them, is one of their primary investors. And he was talking about this a lot in a recent interview. It's just the rate of shipping matters a lot. And if you can grow as an organization, but still commit to continuously shipping a lot of product, you'll be able to kind of outrun competitors and innovate your limit at the same time. But it probably means, especially for new entrepreneurs, and I'm curious for your thoughts here, is shipping things that you think are ugly or that don't work perfectly. Just getting things out the door in order to start getting live data and live users on them, knowing that you're going to go back and improve them afterwards.
Yeah, prioritization is something I've learned a lot about. Knowing when is enough is critical. I mean, Mark Zuckerberg said a long time ago that done is better than perfect. I don't think it's the right decision to you never want to be sloppy. You don't want to just sling out stuff and create crap and build crappy products and then say you're going to get feedback, because you're not going to get the right feedback. You're going to get the feedback that this is crap. and like you need to start over, which is not, sometimes that is what you want to hear, but you want to hear kind of more nuance in your feedback. But I think a lot of it goes back to what I was saying, is being able to be fast when it comes to making decisions and because ultimately products and features are really just a thousand small decisions all piled together, and being really intentional about making those decisions in the right order, focusing on the right decisions and doing it is really critical. I think this is something that Ramp is really good at. I think they get something good enough and then they ship it. They let the market give them feedback and then they improve it. And they're able to create enough autonomy on their team where everybody on the team is doing that. Everybody in the team has enough decision-making discretion, not ultimate discretion, not complete, total unlimited discretion, but they have enough discretion, and they hire good people that are able to, work within the constraints and do what they think is best, and then let the market give feedback to them, which is extremely hard as an entrepreneur, because many entrepreneurs want to make all the decisions. And as an entrepreneur, there are decisions that you absolutely must singularly make, or a group of co-founders need to singularly make, and you don't delegate to everybody else. Getting that mix right is extraordinarily hard, but you can't do it for everything. And so I think Ramp has been incredible at that. And so, yeah, I think you're right. I think it's the speed of shipping has accelerated dramatically as people are able to build products faster. I also think that building the right products has probably gotten more difficult, because if you can build 10 things in the time that it takes to build one, you may not spend as much time thinking about, well, where do I focus my attention? Because you can get to everything, but that's never going to be the reality. You're never going to get to everything. You need to get to the right things first, and then follow in importance after that. So, I think all of these things are really critical for succeeding today.
It's interesting. I hear a lot of feedback from founders about other VCs when we share a cap table, and they have meaningfully higher affinity for the VCs for themselves were founders before, or operators who built startups. It gives you an appreciation for what actually matters in a way that I think is non-obvious when you first start a company. Obviously, rate of shipping is a big one. But even just focusing on being out in the wild with live customers. I spend a lot of time with first-time founders who like really just want to get everything absolutely right before they have any live customers on it. I'm like, you got to go put this in somebody's hands and see what they do with it, because I promise you they will surprise you. And that surprise will drive a lot of insight. And, your experience, you and Miguel Armaza, who started Gilgamesh, what's it been like transitioning from builder to investor? And how have you found, the subject of this book, the experience building a fintech company, really paying dividends for you at Gilgamesh?
Yeah. I mean, well, you'd have to talk to our entrepreneurs to really get the real answer, but which hopefully is good. But what I would say is being an investor is very different than being an operator, being an entrepreneur. There is kind of it's funny because a lot of times as an entrepreneur, as an investor, you see all these problems that your companies are handling and you want to dive in and tackle them with them. And really that's not your job. I'd kind of say that it's almost the difference between being a parent and a grandparent, where, the parent, is directly responsible for managing, their kids. And the grandparent kind of sits back and they, give them candy and tell, wise old stories and jokes. And then they leave, they're not there all the time. And it's kind of the same thing. The founders of the company are kind of like the parent. The company is the kid, and the kid kind of hangs out with the grandparent a little bit, and you get to say some things and give wisdoms, but you're not there actually doing the things. You're not there actually managing the day to day. And it's also not always good when you try to get in and manage things day to day. So I find that dimension it probably took me some time to adjust to it, because I'm by nature, I'm a pretty proactive person. I like to do stuff. But as an investor, you that's not necessarily always what you should do. But I think the big thing that entrepreneurs appreciate about investors who've started companies, and also investors that have simply spent time working at companies to a material extent. So Nick, I mean, you've spent time doing this too. You've seen kind of the beast from the inside. You've seen the kind of what it's really like to build a business, how messy it is, and how simple things are difficult for reasons that are really hard to articulate, and how stressful it can be to build a business. I think a lot of it is simply, in communicating with entrepreneurs, somebody who has built businesses and now is an investor is just going to talk about things differently. They're going to understand, almost subliminally, how things are hard that seem easy. And you can simply relate to people. You can empathize or sympathize with them better in both directions. And so I find that the conversations I get to have with entrepreneurs because of that are very different. I can share war stories. I can share, just funny stories about things that went horribly wrong. And other investors don't really do that the same way. Either because they don't know about it, or when it happened, they were pissed off, or like they just experience it very differently than somebody who has kind of been in the seat that they're doing that. And I think as a former entrepreneur, you understand a little more intuitively what actually helps the entrepreneur. They not so much giving them tactical advice on how to run their business. I guarantee you the entrepreneurs have thought about all of it. It really making introductions for them that nobody else can make. That's a huge one. Just listening some, I think, is also good. Sometimes when an entrepreneur wants to talk to you, they just want to unload. They can't tell people a lot of this. They can't tell their employees all the things that are on their mind. And they probably can't tell you everything, but they can tell you a lot more than they can tell other people, or people that don't work at the company, that they don't listen actively in the same way that you're going to be able to do it. So, Yeah, I think not every investor should be a former entrepreneur. I think that there's really great investors that haven't done that because being an investor is hard. It's a skill in and of itself. And Warren Buffett didn't run companies, but he was a really good investor. And there's some of that in venture as well. And there's an art to venture that you do get better at over time in the same way as anything that you practice a lot. But I think every cap table benefits from having some of the folks on it who've actually, run something in the past.
Well, even if you can't find an investor who's a former founder, at least you can now reach a great book with insights on how to actually build a fintech company. Very different, I think, from building most other kinds of tech companies, honestly. Fintech is not consumer products. It's not software. It's not, hardware or durable hard products. There's a lot you have to understand that's not true in many other sectors. So I'm glad that fintech founders now have one more resource. Andrew, thanks for joining us. Is Finance Technology: Insights for Building an Enduring Fintech Company coming out on April 1st?
Thank you, Nick. This is great. It's always fun to talk about this stuff. And I encourage everybody to check the book out. It's also got some funny illustrations that I did myself, which I don't know, I'm not qualified to do that at all, but at least can give a small laugh as you're reading it. So this has been a lot of fun.
That's worth it alone, man. Good to see you.
You too.